It's never dull, is it, Bob?
No, it's not.
I mean, you look at the end of QE and all that. What would you advise clients this morning about their fears of when the Fed raises interest rates?
I actually think the Fed got it right. And when I listened to Scarlett and she started off by saying, say goodbye to easy money, that's not actually the case. You have zero interest rate policy, and you're still running the Fed funds rate at a negative real rate. Unless they get to zero or positive, that's easy money. That's good for assets. Clients should not be worried.
So say goodbye to new normal easy money. We're returning to old normal easy money.
Okay, that's a lot of adjectives, but I'll go along with that.
Within that, where's the coupon? Is it parsing the fixed income market, or when you sit down with everyone at JPMorgan, do you say, okay, now what across all assets?
Well, we've been saying now what across all assets for a while. And I think everyone's looked at the pricing of different parts of the bond market in particular. And the Fed started by calling out the bond market a few months ago and talking about high yield and levered loans as being overvalued. It's not so much where credit is priced or where risk assets are priced. It's always been about real yields being too low and the government market being
well, we know there's taper tantrum. There's also Lisa tantrum on the bond desk here at Bloomberg News. What did you observe at 2:05 p.m. yesterday? In the trenches, which part of the bond market took the news most abruptly?
Well, I think that the people who are hoping that the Fed would be a little more dovish and would come out with some sort of soothing credo to say, listen, we're in here, we're holding your hand for longer, their hopes were dashed. And I think that, you know, going forward, one of the most interesting things is in the past, volatility has scared the Fed. They have not wanted too much volatility. They've tried to damp it down. Here, we're seeing the opposite. They're saying, you know what? Go forth and conquer. Allow the volatility to come on up, and let's see what happens.
Well, Bob, how much more volatility can the Fed tolerate then?
Well, it's an interesting question, right? Is there a Yellen put out there? Certainly, she could have been a lot more dovish in the announcement and focused on the decline in inflation expectations. And the very fact that she didn't suggests that they were okay with the volatility they've seen in the recent weeks and the correction in asset prices. So I think they desire greater volatility in the markets. Of course, they don't want runaway volatility. They want some control over it. But I think they left themselves enough levers to pull.
The dove this time around was Narayana Kokerlakota of the Minneapolis Fed, who's actually worried about the possibility of not deflation, but less inflation. Does that concern you that we're not close to hitting the target of 2%?
I know, really. It's supposed to be the ideal environment. We have in the U.S. trend-like growth, yet we've got very moderate inflation. When you look at the decline in inflation expectations, it's clearly being driven by energy prices, which should be good. That should be a tailwind to the economy. So I think he is a little bit off base, but I get the point because that had been their previous reaction.
Bob Michael, 6 weeks ago, maybe 8 weeks ago, Bill Gross was unconstrained and told me financial repression out to the end of the decade. Do you agree?
Well, I think there's certainly going to be a lot of elements of that across Europe, possibly not in the U.S.
We may get some nominal yield pickup where we adjust for inflation. We may actually make some money.
Yeah, I think we're headed in that direction.
Is that good enough for you? Can you write a story off that this morning?
It depends on how quickly the yields rise, right? If yields rise too quickly, it's not good for bond investors right now. I think that's going to be the interesting thing.
What is this, a job interview for you?